Now, next up, we have joining me here in person at the Clock Tower at the V&A Waterfront is Omri Thomas, Portfolio Manager of the Opportunity Fund and Rashad's colleague at Abax Investments. Good morning, Omri. How are you?
Morning, Rob. Well, and yourself, thanks.
Good, thank you very much.
Excellent.
Now, Opportunity Fund investors have experienced a strong rebound in performance during the second half of 2020. Participating in the strong equity markets and benefiting from some of the unique investments identified for the portfolio and some of the asymmetric returns that we are seeking within the portfolio. We'll now ask Omri to talk us through the performance drivers in 2020, where he is now seeking and finding opportunities that will help the fund meet its objective of CPI plus 5% in 2021 and beyond. So I'll hand over to you now, Omri. Thank you.
Thank you, Rob. And thank you for the opportunity to present to you guys. I'm glad you could join us on the webcast. So just a quick recap of the performance over the different terms. As Rob said, the last 3-6 months have been a nice rebound in performance, but we were quite disappointed by the performance over the last year. The longer term numbers still looking quite good, but I just want to give you a bit more insight in what the performance drivers were over the 3 months and the 12 months. Over the 3 months, the Eurostoxx basket of notes that we have, at last that return came through and was our top contributor over the 3 months, whereas the rand strength impacted our offshore performance, our offshore assets performance, and that was the main contributor or negative contributor. Over the last 12 months, the Abax Global Equity Fund, managed by Steve Minnar, who you'll be listening a bit later to, did extremely well and was our top contributor. And Sasol, with that big fall that we saw in the first month of last year, was the biggest detractor. So looking at the market, and I think Rashad referred to it, when you look globally, there's not much returns to be had. I mean, yields are extremely low, whether you look at cash, bonds, or equities. In South Africa, we're still in the fortunate position that we still have asset classes that offer real returns. Most of our SA asset classes we categorize in the chi bucket. We've moved SA and emerging market equities to fair, but there's actually a tale of two cities. There's a big part of our market that's trading extremely cheaply, and a part that's trading more expensively. So it actually straddles those two boxes. And the same can be said with for bonds. Despite the attractive high yields on bonds, we are very concerned about the fiscal position of South Africa, and we think bond yields will remain high. So then in the expensive bucket, as I said, most of the developed market assets. So if we look at the breakdown of the Opportunity Fund's positioning at the moment, and I also highlight what it was at September, you'll see a couple of changes that's happened. One is we've increased equities. Domestic equities has increased by about 5%, and that's on the back of the performance of our equity portfolio, as well as additions to equities into the sell-off that we saw at the beginning of the quarter. We also increased SA property into that sell-off, and it was quite timeous. So the big rally that we saw in property towards the end of last year, the fund benefited from that. We increased convertible bonds, and that was mostly with an addition to a new SAPI convertible bond, which we obtained when SAPI was trading at 25 Rand. The conversion price is 33 Rand, just over 33 Rand the SAPI share, and the yield is 5.5%. Now, basically in the space of 6 weeks, SAPI has rallied from 25 Rand to 40 Rand. So it's already through at strike price, and we'll be a beneficiary of that strength. But that bond is not listed yet, so it's an unlisted holding within the fund, and the pricing has not reacted yet. So it's a bit of hidden alpha within the fund, and hopefully that comes through when that bond eventually lists. You'll see that those purchases of property equities was mostly funded out of SA cash. If we look at the top positions within the fund, you'll see the top position in equities I actually highlight as a convertible bond, and that's a Royal Bafokeng convertible bond. And the reason I included it in equities, Royal Bafokeng has done so well that the price of the equity is so far through the strike price that it basically equates to equity at this point in time. Now, why have we retained such a position despite it doing so well? The reason is Royal Bafokeng is one of the platinum companies that's lagged the most relative to other platinum companies. They've also just finished the Styldrift expansion, so all that capex they haven't received cash on, that's starting to become cash flow positive. And last point is that they're increasing the UG2 portion of the PGM metals that they mine. And it's a bit technical, but UG2 consists of a lot more rhodium, and the rhodium prices are extremely high at this point in time, so very positive for them. And with all that, that's extremely cash generative, so we think there's a good chance that they will be looking to buy back this convertible bond within the next year. And typically over the last 2 or 3 that we've seen where convertible bonds have been bought back, it's bought back at a premium. So I'll give you a bit more insight on the convertible bond a bit later. Our second position is biggest position is Naspers, a long-term favorite of the fund. I'll again show you a few more slides on that. And then British American Tobacco, not doing that well last year, but I think it should be one of the foundation blocks of any fund build-up. So looking at our offshore equity exposure, we've got 5% invested in the Eurostoxx notes. And if you've noticed, the Eurostoxx index has actually done extremely well. And these notes will, if the index stays here, it doesn't even have to go up, will give us a handsome return. So the risk-return payoff profile of our notes basket are very attractive at this point in time. And then we've retained quite a decent holding to the Abax Global Equity Fund. With our derivative and currency overlays, our FX exposure is close to the maximum. And as Rashad indicated, we don't know when, but we are concerned about the fiscal outlook for South Africa and the consequent impact on the currency. So just the first opportunity that I want to highlight, our biggest position is the Royal Bafokeng convertible. In green, you can see the strike price of that convertible, and the black line or the dark line is the share price of Royal Bafokeng. And you can see how handsomely it's through that strike. So it's a very good chance that that'll convert into equity. Now, if we look at the valuation, and here we've included our inputs on what we think is fair for Royal Bafokeng, the convertible, we value it at 188 Rand per convertible. It's currently trading at 175, so we still think there's quite a big discount to fair value for Royal Bafokeng. The second biggest opportunity, or the second biggest holding in the fund is Naspers. And I mean, so I've just highlighted the discount to net asset value that it's trading at here. It's trading at a discount to just its see-through holding in Tencent. But that's been the case for a long time. So what will change? So management have recently, in December, indicated that they're going to buy back both Prosus shares as well as Naspers shares. And they have started doing that. So here in this table, I highlight the total authorization that they've got, 12 million shares in Prosus that they can buy back, and 17 million shares in Naspers that they can buy back. They've already done quite a bit of that, and at prices substantially lower than where both these counters are trading at. So these are value accretive transactions, and we expect them to continue with the buybacks over the next year, which will hopefully in time result in that discount closing. British American Tobacco, so the green line is the dividend yield of British American Tobacco, and the dark line is the actual dividends that they've paid over the last 12 months. So the one thing to notice is that you can just see this consistent, nice upward trajectory in the dividends that they pay, and that gives you a dividend yield of almost 8%. So every quarter, so one of the few companies that pays quarterly dividends, you get about a 2% dividend. So in a yield-starved world where you can get 8% in pounds, we think you have to go far to look for better investments. So in summary, I think while global markets look expensive, we continue to find select value in South Africa. Banks have had a bit of a rally, but still at relatively low levels, with still good capital levels and healthy provisions. So we've still got a decent exposure to banks. The SA hybrids, the Royal Bafokeng one I've spoken about, and SAPI, we think offer a very attractive risk-return payoff profiles. And then investment holding companies with still trading at big discounts to the net asset value. So Naspers I've highlighted, but there are additional shares, PSG, which we've done well, are still trading at an attractive discount, and African Rainbow Capital also at quite a big discount to net asset value. So we've got max SA FX exposure because of our concerns about the SA fiscal position. We think the investment note basket offer a very attractive risk-return payoff profile. But we continue to be cautious on the domestic economy. So bond duration remains low despite attractive yields. And we've increased our exposure to inflation-linked bonds. So we don't think inflation is a short-term risk, but given the amount of monetary stimulus globally, that must remain a left field risk down the line. So for that reason, we've increased our inflation-linked bonds. So we think our portfolio, we're comfortable that it offers a good mix of growth and yielding assets, providing the portfolio with an attractive risk-return payoff profile. The yield of the fund at about 4%, so that should provide a bit of a floor to the return. And as I said earlier, I think South Africans are fortunate in that our asset classes that we can have exposure to offer decent yields to enable you to build a portfolio to give a decent yield. Thanks very much. I'll open it up for questions from you.
From me.
For you, Rob.
From me. Thanks very much, Omri.
Thank you, Rob.
That was really interesting. And just going to touch on one of your comments on the last slide there. You talk about still being cautious of the local economic environment, but you've increased your property exposure.
Yes.
So can you just explain the rationale for that and how that might be at odds or why
that's a very good question, Rob. So I think if we look at property, when we increased our exposure, the amount of negative news that was discounted in the property prices was quite high. So I mean, I'll just use one example. Our biggest holding is an investment in the Pula property. It's trading at over 70% discount to net asset value. It's got a double-digit yield. They continue to pay dividends. They've got quite a wide, diversified portfolio of properties. So we think as things normalize, that would be one of the counters that will be a beneficiary. And as long as they continue to pay dividends, we're receiving a decent yield in the meantime. The loan ratios are not the most conservative in the sector, but still very manageable at about 40%. So we think they'll do well. And many of the property counters are like that. So we've also got exposure to Nepi Rockcastle, which continues to trade well, conservative balance sheet. And if you look at the see-through gearing, again, very attractive gearing. So we do think in properties there's select value to be had, but you must try and avoid the highly leveraged property companies because there are going to be casualties in this environment.
Okay, thank you. And again, touching on one of your last slides on BAT.
Yes.
Seems too good to be true.
It does.
8% yield in pounds.
Exactly.
That is consistently growing as the graph you illustrated.
Yes.
So what might be the threats to that?
So that's a good question, and one we've been grappling with as well, Rob. So there are concerns about the regulatory environment, and there's always concerns about the regulatory environment with tobacco. So that's the first thing. But that's not something new. That's been there for the last 20 years. The second thing is, and excuse the pun, tobacco is a dying industry. So volumes are decreasing on a yearly basis. But again, that's not something new for British American Tobacco. They've continued to be able to, through a change in the mix, through cost optimization, and through growth initiatives, especially the drive brands, managed to keep growing the top line, increasing margins, giving you sort of high single-digit earnings growth. And I think the third reason, or the third concern the market's got is with the acquisitions that they've made over the last couple of years, their debt ratios are quite high. But as I said, it's a very cash-generative business, so the de-gearing will happen very quickly, and then we'll see share buybacks resuming. So all in all, one has to play the long game with British American Tobacco, but as a patient investor, to bank almost an 8% yield in pounds, we think you're getting paid to be patient.
Yeah, exactly. And then, okay, last question from me is on the Euro stocks notes.
Yes.
I see you still hold 5%, roughly a 5% exposure. Just very quickly, why specifically Euro stocks or the European equity market?
Yes.
And why do you still retain conviction that that's a good asymmetric profile available, or return profile available?
Yes. So I'll start with the last part first. So these notes that we have got embedded capital protection levels, and as the Eurostox notes, Eurostox market recovered, the notes started going to a capital protected level, but it's not too far off from current prices. So even if there's a pullback in the Eurostox index, that capital protection will kick in. Why specifically Europe? Because of the high dividend yields that were offered by European companies, that gave us the most optimal potential return. So, I mean, even if the market stays here, our expected return from our basket of notes is mid-single digits. So we think, and if the market runs, it will be even more than that. So for us, it's one of our favorite investments within the fund at the moment.
Okay. Well, thank you very much. I'll have to leave it there. We've run out of time, but thanks for your comprehensive presentation and for coming in to join us here today.
Excellent. Thank you.
Thanks very much.